Hey, what's going on, Cashflow hackers? It's Chris with Life 180. I am here with Garrett Gunderson, and we are talking about index universal life and what does it look like during retirement? What does it look like when you're taking the different options of loans and wash loans and index loans, and how does it impact you, and what are the potential risks in it? So we're going to get into this, and I'm really excited to get into it. Actually, we just recorded already. It was straight fire, and really excited to show it to you. So stay tuned. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's go.
All right, here we go. We're diving in. There's tons of people that are allocating their funds into a so-called retirement account of Index Universal Life. But what's the problem? How many people do you know, or that you could find, because I know that my guest has scoured the earth looking for them, that are in the distribution phase of this? And what happens to the policy fees, the amount of risk, and what happens when there's not the performance you thought along the way when you want to take distribution? There's a myriad of books talking about tax-free retirement, and this is the way to go. But if you use the wrong chassis, if you use the wrong policy, what you're going to find is when it's time to rely on what you've built, it may not be what you accounted for. So, Chris, let's dive on in. The guy that, I say you pick fights, but you just call things out, and then these guys come back to you, but then they won't debate you.
They don't debate me. I get comments every single day about people telling me that I'm mischaracterizing IUL and everything it is, and they go, I have plenty of clients that are happy with this, and the policies are performing great. I'm like, that's great. Show me one. I'll give you $2,000. You know, and they go, you're mischaracterizing. Explain to me exactly. Give me one example of something I'm mischaracterizing, and then they just ghost me, and they just disappear. So it's easy for them to just like drop comments and run and not have to back anything up. And, I think that's the challenge. And unfortunately, in this microwave kind of mindset mentality of the world that we live in, and, TikTok and Instagram Reels and even YouTube Shorts now, right? You can't explain this stuff in 60 seconds, and that's the challenge. You got a bunch of people that have been in the business for 60 minutes using 60-second videos to sell people to put their entire financial livelihood into a product.
And then what happens when they get to that time to count on it?
Yeah, exactly. And that's the thing is, like, it
doesn't work for us to say, I told you so. That would be heart-wrenching, right? Like to
totally.
The policyholder.
And that's why people ask me, they say, Chris, why do you spend so much time doing this? To me, it's a very personal thing, because I was on that space. I sold a lot of IUL.
That stuff. Yeah.
And I realized, based on conversations with actuaries and people that I shouldn't have even had access to, right?
Tell me what those were like with those conversations. And
it was a really
when did it hit you? Did you have that gut reaction?
So I'll tell you the exact story. So I was down in Atlanta, and I was meeting with Don Blanton. Do you know Don?
Mm-hmm.
So I was meeting with Don, and I was with the
Circle of Wealth.
Circle of Wealth. Mm-hmm. Yep. And Don is just an amazing guy. And so I was down meeting with him, and I was trying to pitch him on why IUL was so, because I just got done a meeting, and he was just touting on whole life insurance, and me, at 31 years old, like, this big shot with National Life Group and going through his master mentorship program and all this stuff. And I was just like, I was riding in his F-150 with him, and I was like, why don't you focus more on IUL? Like, you're missing the boat. And he's like, son, like, you just don't know what you don't know, basically. And I'm like, well, I'm here from a company that does IUL, like, talk. And he's like, listen, son, I'm not going to debate this with you. There's some questions that I want you to really contemplate and really ask yourself. And so he's like, if you are the policyholder, what are you buying the policy for? And I mean, it was a half-hour conversation, so we don't have time to get into it all. But at the end of the day, the fundamentals that I got from that conversation were risk and understanding what the risk is. And what he alluded to in this conversation is IUL is simply the insurance company shifting risk from them to you, the policyholder. Mm-hmm. And so
I call it levers that they can pull,
right,
for profitability.
Yeah, I've done videos like 7 levers IUL, companies, like all these things. But I went home, and I was at home office, and I was in the cafeteria, and I met up with just coincidentally met up with one of the actuaries, and I had all these the comments that Don was talking to me about in my head. So I went up to this actuary who I was really, if you know anything about life insurance companies, which I know you do, the the leadership does not want agents or people in the field talking to actuaries.
That
is like a firewall.
I went to the Guardian home office when I was in my early 20s. First time I've been in New York, driving a car.
Yeah.
Intimidated, coming from a small, coal mining town, parked where it said no standing, which meant no parking. I'd never heard those words.
Yep.
Luckily didn't get towed away. Met with a lead product designer. I had a red memo pad, asked them enough questions.
Yep.
They said, you should meet with an actuary and ask those things.
Mm-hmm.
And this actuary looked at the ground while he talked to me, like as analytical, introverted as any human I've ever met.
Crazy.
And definitely learned a lot from that conversation. It was one of the more boring conversations I've ever had, but it was also one of the more enlightening conversations that I had. And I was like, okay, wait, I am thinking about things quite wrong.
Yeah. When you understand the concept, one of the things that I just fundamentally speaking, and I'm going to show exactly why I believe this, right? So one of the things that I think is really important to understand is not just what you're doing, but why you're doing it, right? And why, if you're going to put your money with a life insurance company, and you and I both believe there are a million reasons why you would want to, right? But leaning on a life insurance company to get the highest and most maximized internal rate of return and get the best investment that you possibly can. This is one thing that I got out of this conversation. He's like, Chris, and back then it was a little different because rates were higher. It wasn't quite today's environment. Actually, it was probably similar to today's environment. But one of the things he said is, Chris, we're illustrating internal rates of return 30, 40 years on these IULs at 8.5%. Okay. The insurance general fund.
An internal rate of return is what it's getting.
Net of all fees.
Net of all fees, right?
Net of all fees.
So it's okay, you've covered all the insurance company costs, all the,
yep. So because I asked him some very pointed questions, and he basically and I'm summarizing, right? So, but he was also very pointed, and he was like, Chris, listen, we were a whole life company since 1842. Okay. We shifted to IUL in the early 2000s. And we did so because the company saw the direction that interest rates were going, declining. They saw the stress that was going to put on the company. And so they launched and got into this space to shift the risk from the company to you, because all the whole life policyholders have guarantees, and we have to meet those guarantees, and we have an obligation, and those people are partners with the company.
Contractual, unilateral contractual.
Exactly.
Right.
And he goes, we needed to create another profit center that if anything went bad, and if everything, we have the ability to control the levers in there. That's where I got the word levers, right? Control the levers to be able to impact that and make sure that we can meet our guarantees for the people that we have to meet the guarantees for. Right. And so I was like, whoa. I'm selling this as all these solutions, right? All the way that I was selling it as safe, upside potential, downside protection, can't lose, all the ways that you're told to sell this and that people are taught this. That's why I don't begrudging anybody for being excited about this when they get into it, because if you don't know what you don't know. And what is it Edward Thoreau? Who's the guy that says, it's not what you don't know that's the problem. It's what you think you know. That just isn't so.
Yeah.
Right? That's the problem with the IUL market right now. They think they got it all figured out.
I thought that was Mark Twain that said that.
Oh, maybe that's it. Maybe that's it. So
and if not, I giving him some credit.
Sure, totally. He deserves it. He's done a lot of good stuff. So here's the deal. When he was telling me, he's like, we're just shifting the risk, and I was just like, whoa, that's the opposite. And that was kind of what put it was the virus or the bacteria that got into my world of thinking about IUL. And from that point, I went down this deep dive.
What was it like when he said that, though? When you had, because I remember
I was scared.
I nearly threw up when I realized variable whole life is what Guardian had a product in. I don't know if it still exists, when I was an agent, that I was peddling during the 90s. And when he showed me how thin the margin, I got physically ill and was scared.
Well, it didn't hit me super hard at first. At first I had this kind of well, that doesn't make any sense. Why would you be telling me this? It's completely the opposite. He worked for the same company of the people that I was getting trained by, right? To go out and sell this and then train other agents to sell this. And so to me, it was like this. There's a glitch in the matrix, right? Like it was before.
I was thinking red pill, blue pill the whole time here.
Totally, right? Like, so I'm just like, this doesn't make any sense. Like, why you don't? Like, I can't tell the actuary he doesn't get it, right? Like, he obviously knows something I don't do. I don't know, and so that conversation with Don and then with him is what started my kind of journey, because you and I are the same. Like, I'm always looking to kind of discredit my own way of thinking. I'm always trying to figure out, like, devil's advocate, why am I wrong? And I know I come across on my YouTube channel as like very adamant and very matter of fact. That's because I've spent hundreds of hours behind the scenes trying to convince myself that I'm wrong, you know? And now I just know that how hard it was for me to come to that realization, and the problems that I saw in that process, the hard conversations I had to have. Like, there's nobody that's going to go through this that I can't relate to. You know what I mean? And probably I can relate on a much bigger level, right? And so here's the thing. One of the things about IUL, there's a couple things I think before I get into this that I want to misnomers of IUL.
Yeah, not like I have questions on this.
Okay,
because I'm extrapolating certain things from my mind.
Okay.
Based upon what I use, like, because I haven't sat down and sold insurance since like 05, 06.
Sure.
But I have a really good memory of every single thing I learned that I can still talk about. But the first question I have is, if someone takes a policy loan from an IUL, does that impact their cost of insurance?
Yes and no.
Okay.
So with IUL, when you take a policy loan, there's two options. You can take a wash loan, or you can take different companies call it different things. It's basically either a participating loan, an index loan, a variable loan. Every company kind of calls it something else. A wash loan is exactly that. Is when if I take a loan at 5%, then I'm going to earn a crediting of 5%. Okay.
Right. So you're no longer in the index during that loan.
Right. For the portion that you have a loan on, it's kind of the equivalent of a direct recognition.
Which is
whole life
in a whole life there, you're earning the same as you're being charged.
Exactly.
Right.
The difference with whole life, because this is a pushback that I get from a lot of IUL agents, because they say, hey, if I just move the option to a wash loan and don't do the index loan, which, by the way, you always run the index loan when you're running illustrations to show maximized income, because that's how you build in the positive arbitrage, which allows them to show you more income.
And let's explain arbitrage. Basically, if I'm earning 5, but I can get the money for less than 5, I'm in an arbitrage situation.
So in this situation, on this illustration specifically that I'm going to show, it's a 5% loan, and you earn 50 basis points more. So the policy's earning
5.5. So that's arbitrage, because you have this, essentially, like, if you could buy something on a border town and walk across that border and sell it for twice as much, Dallas Buyers Club. He was going and buying all this medicine in Mexico, then bring it back and could sell it for less, but still more than he was buying there. So, like, that's arbitrage. It happens in finance. If someone's got a mortgage at 2%, because they got the mortgage in 2021.
Sure.
And now they can go put their money in a CD for 5%. That's an arbitrage. They're using the bank's money to earn more than what they're paying.
That's how banks make all their money.
They're in the arbitrage game, and they're just really good at it.
Yeah, they're the best.
Right. So there's a unique time where some people could be arbitraging the bank, which is rare. 100%. But this is the 5.5 versus 5. IUL people love to talk about that positive arbitrage, right? So can it impact, if it's in the indexed option, it can impact the cost of insurance. If it's in the wash loan, it's not impacting the cost of insurance, but it's impacting the return on the policy.
It's really important to understand this, right?
Yeah.
So
this is something I've never dived all the way into. So I'm excited that we're doing it today.
So this is the most important element. So there's a I think is an important element to understand here. One of the biggest misnomers about index universal life versus the whole life conversation, because I think it's important that you understand how they, correlate together, right? Or interface together. All IUL agents will tell you that whole life is a more expensive insurance. IUL is cheaper. The answer is that's an absolute falsehood. Throughout the contract, the entirety of a contract, whole life insurance is cheaper than index universal life. Whole life insurance is going to be more expensive for the first 10 to 15 years if you're young. if you're young. Let's assume you're 40 years old, something like that.
Mm-hmm. I like that
IUL,
you consider 40 young.
that's
good.
the
That's
older
good.
I get, the younger, 40 is, I guess.
You're older, not old.
Yeah,
That's
I
what
know,
my buddy Marcus would say.
exactly, right? And so, but like if I bought an IUL policy when I was 40, it's annual renewable term, right? And so the term insurance at 40, like let's say in this policy that I'm going to show, it's $200,000 is the death benefit component to it, right? So it's option B, meaning the death benefit is going to increase, okay? And as the death benefit increases with the cash value, the net amount at risk is simply the death benefit minus the cash value. That's the net amount at risk. And that whatever that number is, that's the amount that the annual renewable term is based on.
Charged, yep.
Okay. And so the idea is do option B. So the death benefit, it goes up all the while. So you're always having that, like, just say $200,000 of coverage. And then when you hit retirement or you stop funding the policy, you're supposed to switch to option A. So as the cash grows, it eats into the death benefit remains the same. It's supposed to eat into it.
Yeah.
Lower the cost as you get older.
One of the two costs.
Exactly.
Because you have this other mortality cost that's working against you, that the older
Correct.
you get, the higher your annual renewable term is.
Yeah.
It looks hidden on the illustration because they're showing the best case scenario with return, lowering that cost of net amount at risk, hiding the additional cost of age. And that's something I really want people to understand that almost nobody has heard of.
Few people realize
or talked about, but we have two things that really impact the annual renewable term the most. Net amount at risk, death benefit minus cash value, and mortality experience.
The actual mortality expenses.
Right. And so here's where it got really ugly back in the day. Early index universal life policy, actually before universal life policies in the 80s, where interest rates were really high in the early 80s, kind of like what we're seeming to want to head towards. Hopefully not that bad.
If we get that high, we're all in trouble.
We're in big trouble because you can't finance $31 trillion of government debt at that interest rate.
I just saw, by the way, side note, our government expense on paying our interest on the debt just superseded national defense for the first time.
Yeah. And that's what happens when you add 4.5 trillion to the balance sheet without printing a dollar. They just put it on the balance sheet.
I know.
Whole other conversation.
Side note.
But I want, like, what happens is all the time they're coming up with new bells and whistles and marketing and stuff. So like early on it was worse with universal life. They were always coming up with new stuff. So if you had good health, you could jump to a new policy. But if you had bad health, you had to stay with your first policy or your existing policy, which left more people dying per thousand in that bundle because they determined the mortality experience in a per thousand death experience. Cost per thousand. You'll see it in the contract. So as that increases, your cost of insurance increases because it's a lever that the insurance company can use to protect themselves. And so like that, why aren't more agents talking about that? Because it's just detrimental to the sales process, or they don't know. That's the question I have. Which one is it?
I think it's incompetency. I think it's just, and I don't mean that critically. I just mean most people selling IUL right now are in the business for a very short period of time, and they just haven't gone down the path of really understanding how these things work.
Yeah, what happened to me was I started to talk to older agents when I was young.
Yeah.
Like they had been in the business 30, 40 years. Because when I started, I would do joint work. I would bring them in to work with clients that were beyond my intelligence and capacity and know-how at the time. I was 21. And I would say, why aren't we doing this? And they're like, well, what you don't understand. And then someone had me talk to another individual that had a VUL on their husband had a VUL who died, but the policy lapsed before. Because they couldn't keep up with the increased premiums as the market went down from 2000 to 2003.
Yeah.
And they were sick and not earning income during that time, and they didn't have the resources to cover it.
Yeah.
And they were supposed to have $1 million in this thing because of market performance.
Yeah.
But it was wiped out at an inconvenient time. So when they died in 2005, their policy had lapsed in 2004 because of 3 down years in the market, and they were were older.
The .com bust.
And the agent would have said, well, it wasn't funded properly. I told them to fund it more. I'm like, well, the problem was the assets funding it were also in the stock market and were decreasing in value.
Mm-hmm.
Their increased demand of expense to go through the treatments because of them being sick had increased.
Yeah.
And it's like no one really thought of those things. So like that was a big eye opener for me. And I started to research this stuff because I was like, I don't want to put mom and dad and grandma and grandpa and my friend's parent, like it was all people that I knew and loved and would see all the time. And I was like, after my market debacle where the stock market went down and I didn't really have answers for them, like the answers, you know what they told me to tell them. The market's on sale. Right. I'm sure you've heard that one.
Yeah.
So I remember thinking in my head, well, wouldn't it have been nice to know that the sell was coming, because it's not like they get to return things and say, I'll take the sell price.
Yeah, totally.
It'd be like buying a house and the next day it loses 50% of value. And you're like, hey, the market's on sale. I'm like, well, I already have a contract and a mortgage. So it actually is bad news
now
for
you're
me.
Underwater.
Right. So that notion of when the market's down, they tell you to buy more because it's on sale. When it's flat, hey, it's going to go up at any time. When it's going up, you got to get in before you miss out. It's always the same story. Buy. So anyway, a little bit of a sidetrack to talk about these two things.
Sure.
Mortality experience and the basic like renewable term on net amount at risk.
Sure.
So it's both, those are the two main factors of pricing.
And here's the deal. The company contractually, when you're running an illustration, you're looking at it, they're showing the current assumption for the
Same
mortality cost, right? Like the actual cost per 1,000. That is always at risk of being increased, meaning the cost is going to get more expensive for you, the policyholder.
How often does it decrease?
I've yet to see it decrease.
That's what I thought. I've yet to see it decrease.
Right.
So it's best case scenario.
Right. I can't say it hasn't. I've never done a study, but like I've yet to hear about it decreasing. So, and I've done a lot of this, right? So,
right.
So there's that. But the biggest thing is I always kind of say, if you're buying the policy for retirement, then why are we focusing so much on the costs and what it's doing for you right now in the next 10 to 15 years? If we're buying a policy to solve a problem, to solve a need, we should be thinking about how it's going to perform and function at that point in time.
Right. You're buying it to have future cash flow.
Totally.
And if that cash flow has risks that could prevent it, we should think about that. So you said yes and no, and I said, does borrowing impact your cost of insurance?
Yes.
So let's clearly tell the viewers.
Well, so there's two things that are happening. So I'm gonna try to go. Actually, let's take a look at this policy loan ledger.
Okay, got it.
Let's take a look at this policy loan ledger here. This is an illustration.
A real illustration.
A real illustration from somebody who is like literally. This is. I was asked to evaluate this. And I love this example because this person put in $12,000 per year. I'm focusing on the policy loan ledger portion of this right now because it doesn't show the premiums that they paid for 20 years. But just so you know, he was contributing $12,000 a year from age 41 to age 60. Now, at age 61, you can see he has $37,884 in loans. Well, guess what? That's income, okay? So his income, that index loan, you can see it's $37,084 in income that year, and he does it every single year. And that's how this thing is designed, just to take that income. So now if I'm the person buying this, I'm looking at this, especially
because the loan, it's tax-free.
It's tax-free.
Right.
Yeah, and that's how they sell it and the benefit of it. But now you could see, and I just want to like look out 5 years, and you could see here there's $189,420 in income that he's taken, okay? Mm-hmm. There's also been, he now has an outstanding loan balance of $215,000 because the loan compounds against you as well. So does it increase or decrease the net amount at risk in the policy? It depends. On the illustration, it's going to always show the net amount at risk shrinking because of that 50 basis points of arbitrage. However, life doesn't exist on a spreadsheet. One of the things that I always like to say is that this policy that we're looking at has a 5% loan rate. I did a look back on this using these index strategies. 40% of the time over the past 18 years, this policy has performed worse than the cost of money at borrowing. So in retirement, this is showing positive 50 basis points of growth every single year, which is going to decrease the net amount at risk. It's important to understand that if the policy performs worse than the cost of money, the loan rate,
the cost of money is what you're.
Then the net amount at risk is going to increase. And as you get older, that means your cost, your annual renewable term cost is going to go up. Your cost of insurance is going up, right? And that compounds against you because now what does that do? That makes it so your cash value in the policy, because you're not paying premiums anymore.
So to get the 5.5 when you're paying 5, there has to be something underlying that takes place. It's not guaranteed.
It's not even close to guaranteed. And furthermore, if you choose the other argument is, oh, Chris, just choose the wash loan. Well, there's a reason they don't illustrate it with the wash loan, because the wash loan would take out almost 40% of this income, right? It would just eliminate because the company knows the risk, right? Because what happens is if they do the wash loan. So what has to happen
with the index in order to have the wash loan? It has to get a minimum benchmark?
No, if you do the wash loan, it's a credit wash loan, across the board.
But I'm saying the arbitrage.
But here's what I want to, so just to answer that point directly. So index universal life, do you know what it is?
Yeah.
It's universal life. It's universal life, which is a term chassis with an option strategy connected to it.
Totally.
So if I go,
let's talk about that option strategy just briefly.
Okay.
Because I'm not a fan of options.
Okay.
And
so
I'm very public about. I think options is just gambling.
So
although I get what they're doing, how they're basically zero coupon bond, is that what they're using, or some type of bond strategy to get the minimum, and then they're doing a straddle with the option?
All right. So this is how the policy grows. You pay a premium. Okay. Let's say you have, let's say whatever your premium is, let's say it's $12,000 and $10,000 is going into accumulated value. Okay. What happens is with every company, this money then goes into the general fund of the account. The life insurance company, they're all very conservative, right?
Right.
So the company may say, we know that our general fund is earning 4.5%, right? So they know that ahead of time. And so they create an options budget based on what the general fund is performing at effectively. So they may say we have 4.5% is what the general fund is. So in this situation, what they would do is they would say, all right, we're going to take this 4.5%, and instead of crediting, which would be $450, right? Instead of crediting that $450 to the $10,000, they say we're going to take this $450 and we're going to go buy options with it.
Yep.
Right? Now, there's only two things that matter. When people sell IUL, they talk about the fact that, or they try to convince you of the fact, which is not the truth, that you should look back at, let's just call it the S&P 500, because that's the most common index that's used, right?
Yep.
So they'll tell you, look back at the S&P 500 over the past 15 years, and it's averaged whatever the number is, 9%. Right? And they say, and I don't know if that's an accurate number, but I'm just hypothetically speaking. So they say, look, it's been averaging 9%. We're only running and illustrating this at 6.4%. So look how conservative that is, right? In reality, the index performance has nothing to do. I can't say nothing. Has very little to do with how this policy is actually going to perform. And here's why. Because it's just one element of the entire equation, and it's the least important element. Because what happens is you have the options. Now, you have the options budget, which is this $450, which is generated by the general fund, which is what? Generated by the interest rates, the fixed economy, the bond market, all these things that life insurance companies invest in.
And what option strategy are they typically using?
They're just buying call options. That's all they're doing. There's
call is like if the market goes up, they're getting an exaggerated win on the up.
Yep.
If it goes down, the option expires and they lose. But the general fund gets them to zero.
So you were alluding to all these different ways that you can do options, right? Like, and it's not that sophisticated. They do it very. So when you look at an illustration, and I encourage everybody to do this, you're not going to see this.
I'm just going to give someone a really basic understanding of options.
Okay, go ahead.
Think of call as you're calling someone up. Calls, or you're hoping it goes up.
Yep.
Put is you're putting someone down.
Okay.
Puts mean you want it to go down.
Okay.
So if the market goes down, you win in a put. If the market goes up, you win in a call.
Perfect.
It's that simple.
It's that simple.
Yeah.
Yep. And so what these guys are doing, there's two things that really matter. Is you have the general fund performance, which leads to, and I'm simplifying this a little bit, but it really is how it works. You have the general fund performance, which leads to the options budget. I don't know how I keep going here.
Yeah, it loves that eraser for you, doesn't it?
Because I keep tapping it. That's why.
if
So
tap
you
the pen,
go
yeah.
the
and you're
really
you're hitting it with your wrist, I think.
okay. Here we go. So you have the options budget,
Yep.
and this is so important. Then you have what options cost. So a lot of people right now, this is the ironic thing about this is that IUL screwed either way, and I've had conversations with some of the top minds in the industry.
I told you have 27 whole lives.
What's that?
I have 27 whole life
27
policies
whole life policies.
and one IUL.
You have an IUL?
Hey,
Dude,
man,
I want to look at that.
my plan with the
evaluate
IUL
that
is
thing.
to cash it out. It's not to keep the death benefit.
It's not
at
going to
all.
grow. I bet you, I'll make a little side bet with you that your whole life outperforms your IUL.
And
at the
we'll
end
go
of the
ahead and
day.
do a video on it. We'll
Like,
we'll just put them
crazy.
side by side
Yep.
and take a look at it.
Yep.
And the IUL's on my wife, which
Who's healthier or younger? I mean, she's a
Both.
woman. She's a woman.
Both.
Like, yeah.
only a year younger than me, but still.
And
And yeah, like her.
Yeah.
So that should perform better on a female versus a male based upon actuarial tables.
Yep.
And
Totally. So here's the deal. The options budget. Here's let me tell you the story that a lot of the agents are
You
talking
just looked
about.
at me like, I can't believe you just confessed that.
I can't believe you have an IUL. I'm so
Sorry,
sad.
I had a 401k
I mean,
once and I cashed it out.
Yeah. Yeah. You
like
should
the
1035
10%
here. I don't know. Like anyway, that's a whole different
Yeah,
conversation.
I'll probably 1035.
Yeah, but so here's the deal. Your options budget by the general fund. Okay, so in this situation, let's just use this as an example here. $450 goes towards options.
Yep.
That's the first part of the equation. So a lot of agents are saying, well, Chris, the general fund performances right now are going up. So as the general fund performances go up, the performance of the IUL is going to go up because we're going to have a bigger
Right,
budget.
because interest rates are
We're
going
gonna
up.
buy more options, right? Not so fast, my friend. Let's talk about, as in the words of Lee Corso. So let's talk about options cost. So you did a great job describing options in the
Thank you.
simplest, the explanation that I could ever think of, and that's fantastic. It gets a little more complicated than that, though, because if you understand options, I can't just go, I want to go buy an option on a contract. Because when you're buying options on specific contracts, specific indexes, specific.
Right.
There has to be people on the other side of that transaction that
Willing
are
to do
willing
business
to do
with you.
business.
So when you say contract, explain what you mean by that.
So you're buying an options contract, and
Is that thunder?
it
It won't pick up.
No,
on the
that's
mic, I
cool.
don't think, but
That's awesome.
yeah.
We're in the middle of a storm.
We're in a
It's
storm.
so indicative
It's
of
like-
the financial storm that we're in. But so here's the deal. An options contract is basically, it would be me saying, hey, I think the market is going to do X. And you go, Chris, I own that. I don't necessarily agree with you, right? And I say, okay, I'll pay you for the rights of your shares. And if I'm wrong, you keep my money, and if I'm right, I get your share. I get the gains.
Look how easy that was. You just did a great job of describing that.
I mean,
Love
that's
that.
it. So
that's it.
So that's it. And so here's the deal. It's a supply and demand thing. I can't go get an options contract unless I got a Garrett on the other side of the transaction willing to.
And by the way, the reason I don't like options and why it's a travesty that I have an IUL because it's running on options is because it's win-lose.
Totally.
I don't like win-lose.
No.
In,
Not when
value,
you're not
in
in
a
control.
value creation economy,
Yeah.
even when I'm in, I just want a
Okay,
value creation
sure.
economy that if I write a book, someone reads it, they can get
Yep.
value from that book
Yep.
and pay me for it, and we
Totally.
can both walk away
Totally.
winners,
Yeah.
right?
Yeah.
There's just too much opportunity to have win-wins, and business moving to a win-lose strategy is against
Interesting.
my DNA.
Okay. That's interesting. Side note, and I don't want to go down this rabbit hole.
'Cause I know
too much.
you're a
We'll have to
poker
do
player.
a different video on this. I'm all about taking risk at the right times, and I have no problem putting my money at risk of losing money as long as I feel
It's
like I
within
have
your
an edge.
parameters, yeah.
And I'm able to manage the.
You have asymmetric risk,
Yeah,
right? You
asymmetric
get-
return,
yeah,
right?
return,
I'll
yeah.
play poker tournaments. I was used to playing and not cashing and losing 20 times in a row. But when I won, it'd be like the equivalent of 150 poker tournament buy-ins,
Yeah.
right? So it is what it is,
Yep.
right? You just got to know how to manage that risk. Not everybody's good at doing that, right?
Totally.
So here's the deal though, with options, and I'm curious to hear your idea of perspective of the win-win scenarios with real estate, because I think you can lose in real estate too, but I love real estate.
Right, but at the same time, you can provide housing for someone in real estate.
Okay, fair enough.
And they're winning by having housing.
Housing experiences with short-term rentals,
Right,
and
with
all that stuff.
experiences.
Okay, fair enough.
So you
Yeah.
make money because you provided an experience
There's a value
or
add.
a value that they didn't want to provide on their own.
Okay.
So where on a piece of paper, like a derivative or an option, It's simply how do we extract value by being the smarter person.
Got it.
And so I'm like, cool. Yeah, it's like financial bullying. I just look at it as financial bullying.
Yep.
And I also
Fair
look
enough.
at derivatives as being a cousin to options. It's a little different because it's this weird underlying asset. But the reality is it bankrupted Orange County. It was a big reason that we had the problems in 2008 being exacerbated because of over leveraging and margining up so much and inventing products that weren't real.
Totally.
And so like, I just think that we'd be better off not having this. The options traders would argue it provides market liquidity. I would argue not really.
Yeah.
It's there's a lot of these blips that happen because of it that are market anomalies because it pushes things too hard. And ultimately, without going in too much of a tangent, the biggest risk to entrepreneurial value is going public and getting shorted. Because people short people that don't have enough liquidity, extract the value from that, and you know who loses? Customers and entrepreneurs.
Look at like GameStop and that
and
whole
who,
deal.
Yeah, and who wins?
Yeah.
Just the people that are the market makers, and those are the people I think deserve the least amount.
The big money wins. It's a big transfer of wealth.
So anyway,
it is what it is.
And so this is my problem with my IUL is I'm participating in options.
Way to go.
And I also was like, but when I got into it, I was like, this is a 10-year plan. It's just a 10-year plan because interest rates were so low when I did it. But I was like, if I can get this at 2%.
I'm like twitching listening to you talking about having an IUL, but it's okay.
It's fine.
It's okay.
It's fine. Maybe this is because I was out of the insurance industry for too long. But at the same time, I couldn't get any more whole life.
It's a great experiment.
I tried to get
Look
whole
at it
life,
like
and they
it's
said
a great
no.
experiment. It'll be a great.
That's
case
why it's
study.
on my wife.
Totally perfect. So check this out. So let's think about options cost. Talking about it in terms of and taking all the things that we just took into consideration. Options are a supply and demand product. Okay, so options, there's not just one flat cost. The cost of options is going to go up and down based on demand. Those options markets go.
They've got to have
wild
someone
swings.
They've got to have a lot of people working full time just to get the contract,
just to manage it.
Like, because I knew people that were like, I made money doing options. I'm like, how much time did you spend doing the options?
Yeah, totally.
And it's a lot more than they would like to admit.
Well,
I could click a mouse from a beach. Yeah, but you're on your computer, not hanging out.
So let's talk about what determines the cost of the options.
Yeah.
Supply and demand, liquidity, how many options are available, and then demand, how many people actually want those options. It's
so the
like
more IUL policies there are, and the more companies getting into IUL, the more demand means the price goes up on the options, lowering the overall return.
So the options budget goes less. And so when I did the IUL challenge, listen, I know somebody can win the IUL challenge. I know that it's probably not going to happen. And when we talk about, when I always tell people your performance of your
which
IUL.
was you saying, if you can have these things that you say are going to happen in IUL and prove it out, I'll pay you $2,000.
Exactly. The reason I say your performance of your policy has almost nothing to do with the actual performance of the index that you're participating in.
Because it has to do with the value of the option.
Because it has to do with the cost of the options and the performance of the general fund leading to the options budget. That's it. And what they do is these two things set cap rates.
Right. And this is the thing that people get mad about when I talk about cap rates. But I'm like, at what point can't you make more than that? And if there's a huge uptick in the market that year, because you only had a $450 budget, you're not getting enough of the upside compared to someone that's just in the market.
You want to hear a sad story? So you
tell me a sad story.
In 2012,
Chris, can you make me cry?
You might cry after this one. In 2012, I was selling IUL. The cap rate.
See, so you really give me shit about having an IUL policy.
I
you know what I'm saying?
When I realized I was wrong.
How many IULs have been transacted from my referrals? Like, very, very few.
This is why I have a soft spot to a certain element for new agents that I'm just trying to smack sense into them. So cap rates back then were 14.5%.
That's what you could participate into. Max rate. And if the market did 20%, you're at 14.5.
Right, because think about back then, because of the fact that general fund performances was higher, right? It was like 6% back then in 2012, maybe 5.8, something like that, but it was higher. That's a big increase from 4.5%. So that options budget went further. And because there was less market volatility, remember we were coming out of
there's literally 33% more budget for for the options cost.
Your options budget
Yeah,
went that
options
much
budget,
further,
yeah.
and the cost of options was actually lower because
There
we had
wasn't
just
as
come
many
to session.
yeah.
2012, everybody was kind of like starting to get bullish about the economy, and if you understand what really causes
Volatility is
the key because
Yep.
the more volatility there are, the more options more people try to get into options to take advantage or hedge.
Yes.
Right. So when you look at your
like
IUL,
a covered call is a huge strategy.
100%.
That's a hedge strategy
Huge.
that says not going to get big returns, but I'm going to
Yep.
have a pretty good chance to get a stable return.
Totally.
But that stability comes in volatility. That's the strange thing.
100%.
Right.
And so that
We're
volatility.
getting so nerdy at
I
times
know
during
it's
this. You know
it's
what I'm
awesome.
saying?
This is how I do it. So when you look at this, though,
I haven't studied options for 20 years.
really.
That's the last time I've.
But it's
It's just once you know.
if you do not understand options and you are in an IUL contract, you've just committed financial suicide. I'm going to keep using that phrase. Like it is what it is.
Damn.
Like so back then it was 14.5%. So we came through the greatest bull run of all time. Let's say 2012 through 2021, it's a 10-year period. That's during the greatest bull run of all time.
You miss so many upsides.
You like think about not only that, but they're saying that you get upside potential. Okay,
Capped out.
but you're capped out. But here's the deal: this 14.5% policy that I sold back then, I had one person that kept their policy. They have it today. Okay, you know what the cap rate is? And by the way, we were illustrating because of cap rates.
8.5.
7.75. We were illustrating
almost
it.
a 50% less, right?
We illustrated this at 8.1% to be conservative, and now the cap rate is lower than what we illustrated it at.
And so check this out. Plus, this notion that the market averages 9%.
It's a joke.
You have a 30% gain one year, 10% loss the next year.
Yep.
You could only earn 14.5 of the 30% gain. You don't lose. You get to zero. Let's say it's zero on the 10% loss. But if you look at the market trends, you have bigger years than typically you have bigger losses.
Oh, totally.
So ultimately, you're missing a lot of the upside.
Huge.
And not protecting as much downside as you would think. So if we just compared apples to apples for 20 years, the market's going to outperform IUL every time because of the cap rate. Every time.
Yeah, I mean, you and I believe the same things, I think.
Even if we started in the Great Depression when it didn't exist.
Right.
And it took till 1944 for the market to come back from the Great Depression to the levels that it was at the height before.
Yeah.
So like maybe that's the only time period ever where an IUL would potentially be better, than just being in the wild ride of the market.
Because what you're doing by putting your money into a life insurance contract and expecting there to be a return, because when we talk about 8.1% cap, that doesn't include the cost of insurance. You still got to back all those costs and stuff out of it. So you're basically saying like, depends on how old you are and all the variables, but it's worse. Right? It's worse.
Well, look, this product design guy at Indianapolis Life, I could be wrong, but I think that they might have had the first IUL.
No, Transamerica.
Transamerica did. Okay.
But they were one of the first.
But they were top four, like first
one
four,
of the first
right?
Yep.
And this guy scared the bejesus out of me and my partners when he talked about what was going on. Because we were like, well, I wonder how these are and all this kind of stuff. But we were pretty soured on UL at the time.
Yep.
And I'd already had the VUL experience by owning one when I was 18. And I was like, oh, yeah, this is,
The thing is that, so what we have to focus on is the options budget and the options cost. And at the end of the day,
general fund.
And the options budget is a general fund basically that creates that. And so that's what we look at. Those two numbers create the costs that set the performance and set the cap rates, the par rates, and now what are the spread charges? Cap rates, par rates, spread charges.
And so there's cap rates and spread charges.
Because you know why? Because some of these companies have gotten really, really tricky, and they've created uncapped indexes.
Right.
And here's the deal.
That's what I've heard about.
So you can look at right now, and you could go and you can look at a company, and this is so important to understand. You could look at a company that has the S&P 500. They can have a capped index at like 100%, or like a 10% cap rate with 100% par rate, right?
Okay, explain the 100% par rate.
So meaning if the market does 10%, you're going to get 100% of that. You're going to participate 100%.
Yep.
And
Because
so,
sometimes it's 90, sometimes that's the participation rate.
right.
Yep.
So then you have an option 2 index would be like a cap index with maybe like a 10%, and this might be, or no, it'd probably be like 8% with like 140% par rate. Meaning if it does 8%, you're going to earn 140% of the 8%, or you'll earn 140% of the number up to 8%. So if it did 6, you could probably end up at 8. That kind of deal, right? Like that's
because they can play with the options to make that work in a very specific scenario.
No, but here's the deal. This is what I want you to see. So then you can have uncapped.
Mm-hmm.
But
Which
uncapped,
I'm hearing a lot more about uncapped.
It's because it's
with the spread.
It's because people are waking so much up to these concepts that people are like, I'm not going to buy that anymore. So now the companies are being like, oh, we're going to create this new thing that uncaps your potential.
What's the spread?
So the spread is anywhere between 7 and 15%.
What?
Meaning the first 7% of
like
market
2%.
The first 7% of market performance up, and that's right now current, but they have the contractual ability to change it up to 15% of market performance. The first 7 to 15% goes to the company before you get credited anything. And then there's
7%
also
7% return.
Yep. And so then there's other companies that will do there's other companies that will show no spread charge, right? No, and they'll do uncapped, and so it looks amazing, right? Like but here's the deal: they have the safe money rate, the no risk rate. Have you heard so the no risk rate is basically like most companies use like the 10-year bond cost for the no risk rate. So the no risk rate,
what that means.
So like right now, if the 10-year bond is 4.5%, like 4.5-5% is about what it is at this moment in time. They basically say the first, whatever the no risk rate is, these are no risk rate policies, meaning, and they write it into the contract like that, right? Like, and the one we're looking at right now, Allianz, it's a no risk rate policy. So they don't show a spread charge. Everybody likes to tout the transparency of IUL. This is the least transparent thing in the entire life insurance space is how these uncapped indexes work.
It's unbundled, but you have to dive in.
Yeah.
So I get whether,
That's why the illustrations are 75 pages long, y'all. Like, it's insane, right? Like a good whole life illustration, you're talking 18 to 25 pages, right? An IUL illustration with an uncapped index with all the things I'm talking about, 75 pages long. It's designed to confuse you. Like, that's it. Yeah. And so, but the no risk rate is basically like a spread charge. The first, whatever the cost of the no risk money, i.e. the 10-year bond typically, just go Google.
Goes to the insurance company.
Goes to the insurance company. You don't get any credit for anything before that.
Okay, so check this out. Back in the day, this is crazy. So I went and filed a private placement memorandum with the state of Utah.
Okay.
And I had a money manager, and I was like, hey, look, we're going to do these real estate portfolios.
Sure.
But we're not going to charge our fee till people hit 7%.
Yeah. So you get a preferred return.
You know what they said?
What?
You'll have no incentive to support, and they denied it.
Seriously?
So now what they've gone is to these big conglomerate companies and said, great, you can take the profit first before the customer, and that's fine. So like, how upside down is this entire philosophy?
It's bass backwards.
So like the 4.5%, like Buffett said, hey man, if you can get 6 or 7, you're pretty golden in the world, really. And now they're saying, okay, we'll take the first 4.5.
Yep.
And then we'll give you whatever after that uncapped.
If you think,
dude, it's like being in a mutual fund that has a 4.5% expense ratio.
Right. So now that we've talked about this and people, and I'm sorry that went a little long, guys, but like this is
so important to understand if you have
vital.
One of these policies.
People bust my chops about why my average video length is 45 minutes. This is why.
Because of the design of these things that we're speaking
against. Because I
talk
about this stuff a lot, and it's confusing, you know? So side note, video editors, if like while I'm talking about things, if you can find like highlight or do like
what number you're talking about?
Yeah, the number that I'm talking about. I'll refer to the age. You can see age 65, year 25, and just look for the correlating number in the correlating column, and I'll talk to it and just try to edit it in because I can't draw on this iPad.
Because then it gets the restriction.
Yeah, I get the restriction.
Thanks, Allianz.
Still, so yeah, I know, right?
Well, look, we're going to do another video.
Well, we can break this into
IUL.
2 parts.
Yeah, we'll do part 2.
Why don't we just do this part 2? We'll just make it a long.
All right, so let me summarize what we've talked about so far. We talked about in an IUL, Index Universal Life.
Yeah.
There's this term chassis that's annually renewable term
Mm-hmm.
that has two factors. Number one, the net amount at risk. Death benefit minus cash value. That determines what you're getting charged on.
Correct.
Number two, your mortality. The older you get,
Yep.
the higher the cost of insurance.
Yep.
Then we went into wash loans versus index loans, or depending on the company, it might be called
Sure.
a little bit different.
And how those
So,
impact
hey,
net amount
look,
at risk.
you get 5, you pay 5, it's a
Yep.
wash loan. I've heard, like, that was what I learned when I was 18 years old. Totally get it.
Yep.
Index is different because it's variable,
Mm-hmm.
right? And part of it is if the performance of the policy isn't adequate, that 0.5% arbitrage doesn't exist, but it's illustrated
Mm-hmm.
as if it does exist into perpetuity.
Right.
Then we got into how does the cash value actually work?
Mm-hmm.
And it's, well, you have the general fund, and that determines the cost of the option.
The
that you
options
can-
budget.
The options budget.
Yep.
Then that's where you try
Then
to
you
get the
have to-
call. But
Yep.
if they're too competitive or there's too much demand and not enough supply, then they have to change the cap rate at which you can no longer participate above that in the market return.
Right.
Then we went into, well, that's why they had uncapped, but then they started having a hurdle rate where you had to overcome that before you earned that.
Correct.
And call the spread, and then even a risk-free rate.
Yep.
So it was basically dismantling this policy. And the question I asked that got us there was, well, when you borrow, does it change your net amount at risk? And it depends on the underlying performance of the policy,
Right.
or the way that you choose to borrow from the policy. And what I want to get to in the next video is,
Yeah.
what happens when the performance of the policy isn't adequate enough and you run out of runway and no longer have cash in the policy? What do you have to do to make sure you don't ever have to pay tax?
Oh.
We're about to
That's
get
a loaded
this
one.
is okay. So we've
we
covered
go.
a lot. There's more to cover. We've talked about term insurance in previous videos. We've talked about, index universal life. We haven't even really got to whole life yet. This is a series I'm doing with Chris because you deserve to know the truth when you're making these major financial decisions that most people can't look far enough down the road and have compassion for themselves and say, am I doing the right things? And what we tell ourselves is, I don't have the time. I just have to rely on the experts. But what happens when you find out the experts are merely well-intentioned salespeople that have never thought about the questions we're asking? Just like Chris, good guy, hadn't thought about these things until someone confronted him about it. I understand that I was kind of lucky that I made these mistakes before I was married, before I had kids, before I had, the only mortgage I had, I bought a house when I was 19, is I had roommates that could pay the payment because I was renting it out. So people have a lot at stake with their own financial life, which creates this moral hazard we talked about, where it's designed in a system and process that actually puts you in harm's way. So you deserve to know the truth. If this is helpful to you, follow the other videos. These are the deeper dives so that you're informed. Therefore, you can take control of your money and of your financial life and have a better life along the way. So click through the other videos, comment on it. I know you IUL advisors want to argue. I'm up for it.
Let's go. That's awesome. All right. So this video has gone super long. We've covered a lot of things. We're just wrapping in Garrett's studio here and going through all this stuff, having a blast. I love getting into this stuff to this level of depth. And so it's gone so long. We're going to turn this into a 2-part series, and we're going to dive deeper next time. Now, if you are finding value in this, if you're an agent, if you're somebody who's looking at potentially buying a policy, my encouragement to you is we're going to put all of these videos into a playlist, and that way it will make it really, really easy. I'm going to put the link to the playlist in the description below to make your life as easy as possible. Go down, click on that playlist, watch them in sequential order so they all make sense. We'll put them in order to make your life easier, to have all this complexity and confusion around Index Universal Life simplified for you.